Mhm. All right, so good day, everybody. It's just after 6:30 on Wall Street. This is QuantBox Live, where we get our global macro on. All right, hang on. I got to get my drawing tool out of the way. It clicks. Anyways, cool. So we want to uncover the best fundamental opportunities. And the big thing right now is we are very technically high in price in a lot of the markets. We're seasonally, outside of the norm. The market kind of is imbalanced when you look at short-term correlations that then point to a lack of intrinsic trend. That's a lot of mix matching, and it's hard to see a lot of this stuff. It's like, how do you find a black hole in space when space has no color and black hole has no light? How do you find it? Well, through cross observations. You can't actually see a black hole. So how do you find one in the middle of space that's infinitely large? Like, how do you find these things, right? So you have to look at other observations. So to find the intrinsic trend, QuantBox looks at the VIX, the 10-year T-note, the dollar, the yen, gold, the S&P 500, and it looks for the underlying correlated trends. And what we've seen for the last 5 weeks is there is none. So that is a big sign of risk. And it's hard to see, but we can see it clearly because of QuantBox. So anyways, if you're watching this on YouTube, which I don't know if you are, because I don't think I've uploaded videos for a week. But anyways, if this happens to get to YouTube, swing by QuantBox.co, take a trial. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. I hope I'm logged into the right browser. I hope so. I wanted to check. I think I reorganized the videos. I did. Good. So they were all still stuck in January. So I have January archived, and then now we're working on February. So that's cool. So those recordings are there. That's nice. All right. So let's go into the pro. Let's go pro. Oh yeah, good. I am logged in properly. Didn't eat breakfast. Only had one energy drink. What a horrible existence. Excuse me. All right. Yields are up. All right. Well, but not by much. Understandable. Oil's up again. Nice. Oil is up again. Another wave. Did you see it? We can look at it technically if you want. But down to 71. Up, down, buy, up to 73, up, right, up, down, buy. Now we're on 74 on our way to, up. So that's cool. That's working out. Gold still just doing nothing as it should. Okay. Yesterday, we hit 4,998.5, I think it was. Yeah, but not 5,000. S&P 5,000. Maybe we hit that, or maybe we don't. Here's the interesting thing. Because of the seasonality, typically the S&P 500 isn't really rallying this time of year. I can explain why in different ways, but just generally it doesn't. And it'd be interesting if these cycle levels, like the S&P 5,000, what if that's the short-term high? What if that's the high until the end of the year? It doesn't feel like that way now, of course, but it is possible. So I really wonder what's going to happen today, because what typically happens is the stock market kind of falls until around March, and then it kind of goes up until about summer, and then it comes down to about September-ish, and then there's the normal pattern, and well, the normal pattern would be down. So it'd be interesting if we start the year high and then just fade all the way down to the election. I've seen stuff like that before. Um, it's not a call, but I'm like, that's how that psych level would come into play. Nobody actually wants to breach it. But anyways, euro dollar flat, Bitcoin up. Holy smokes. Yep. Holy smokes. Holy smokes. Just looking at the shape here of the stock indices, Japan is flattening out. And look, the American stock markets are catching up. Yeah. Huge. These are huge numbers. Anywho, let's see if we can get an underlying trend. And the answer is niet. You're like, Wayne, how could that be if the stock market just popped? Yeah, but the other things that typically go with the stock market rallying ain't going. So one would assume risk on. Yesterday was a risk on day, massive risk on day, like ginormous risk on day. Or was it? No, it wasn't actually. The stock market popped. But the other things that go with it didn't really go with it. Okay. So, for example, you could say, generally speaking, the dollar is a bit strong when it should be ridiculously weak. It's hard to see this. It's hard to observe it because we also see things with our biases, right? We just assume, I'll talk about me. I would just assume the dollar would be ridiculously weak when the stock market just popped. Yesterday, it just popped. The 1 hour candle was crazy. And we rallied up to 5,000. So I would just assume dollar weakness. And that isn't necessarily what happened. Or if it happened, not to the degree it usually happens. And so this is why we have a machine do it, because a machine doesn't look at it with assumptions and biases. So it's still saying, be careful. What you see might be a mirage. Okay. You need good data and you need good tools. Yeah. Anywho, scatter plot, Bitcoin, holy smokes. Yeah. Bitcoin's back, baby. On its way to 2 million. Nice. Holy smokes. So we call that an outlier. Japan's doing well today. Yesterday was sort of I think it was more of a flat day for it. But so yesterday, if it was a flat or a slightly down day, well, today is definitely already, like a 2% rally. So I suppose Tokyo looked at what happened in the United States of America yesterday and said, well, down 5,000, up. Yeah, amazing. And it could just be American firms that said, down 5,000, buy something else. And on the Tokyo Open, they bought Nazi. The way the world used to work, and it probably still works in a very similar fashion, that you literally went from dealing desk to dealing desk to dealing desk if you were a trader. So you would call Tokyo at the open and you're like, I want to buy gold, you know. There's some great old videos that get pulled off of YouTube, but I don't know who pulls them off. But every once in a while, you'll find Paul Tudor Jones when he was a young man trading. His big thing and his claim to fame back then was betting on the S&P 500 when the S&P 500 was a brand new thing, right? And it was totally new. People didn't even really understand the concept of the index. And they were doing Elliott wave analysis using computers to predict a ginormous stock market crash. So it shows them all day trading the S&P 500. And it's like a whole 1 hour documentary. They're predicting this crash. They're predicting the crash. And of course, it's the 1980 crash. And the documentary is before the crash. So it's just a documentary of them going all through their quantitative analysis of market data, right? And using Elliott wave and then saying the S&P 500 is going to crash anytime soon. And the documentary's over, and then like boom, the market crashes. It's not like the market crashed and they went back to do a documentary. They did the documentary and then it crashed, which is great. But my point is, it shows him. Then he goes home at night after trading all day, intense trading. Then he goes home and then he's calling Tokyo to trade gold and some Deutschmark. It's kind of really interesting. People are greedy on Nikkei. Well, I don't know, Bordeaux, if I think part of what's going on with the Nikkei and partially with the United States as well is I think money's coming out of the Chinese market. It's been falling for years, and I think it's moving to places like Japan. And so anyways, we're just seeing that. So going back to what I was saying, I could see yesterday being a monster day for a lot of equities traders and people that are sort of trading things that are linked to that. And then when it was done, go to dinner and then come back and then call Tokyo and get some Nikkei on. I don't want to look at it. I need to get my other new calendar. I like my new calendar now. The new calendar on traders.co, it'll just say, here's the nine things you should care about this month. And I love it. And it tells you, if it's 3 days away or like 3 hours and 22 minutes away, it's just counting down. I'm like, I like that. I like that. And you click on it and it tells you what's going to happen. I'm like, that's cool. It's cool. So anyways, okay, we don't need to do that. Seasonality, don't need to do that. Look at the heat map quickly, see if anything's changed. Clearly, Bitcoin is crushing it. So this is bad. Yields going up are bad. But it's happening. Boy, oh boy, huh? Holy smokes, are we going to go higher? I mean, it's going to be the news of it could be the news of the day, but like I said, it could be the news of the month. It could be news of the quarter. It could be news of the first half. Like, seriously, why not go from 5,000, I'll just make up a number, 4,250 by October, and then by January 1st, we're back at 5,000. Right? Like a slow decline. Slow, painfully slow. And then pop right after the election. The day after the election, actually. So, yeah, anywho, and that's my problem. That might actually be a weakness that's some vision that pops in my brain, but it might be unprobable, but it's in my brain. So we'll see. Again, a machine doesn't think that way. What else? Rand getting pummeled on, well, strong euro or strong Swiss franc hurts South Africa because that's their debt. Everything's done in euro and dollar. Yeah. Okay. Yen up, yen up, yen up, yen up. All right. So we're starting to get either currency strength or the yens are starting to weaken. Yen, the actual yen, and that's a risk on thing. And so like yesterday we had that monster day. You would expect all yen pairs to be up huge. Well, for the week they're barely up. Okay, Aussie dollar down, Aussie Kiwi down, Aussie CAD down, Aussie's still quite weak. And then like gold, neutral. Neutral. So normally we would look at stuff in the middle and see if it's going to go anywhere, but it's hard, man. It's hard when there's no underlying intrinsic trend. What ends up happening is that, again, it's sort of our brain versus the QuantBox brain, right? The human versus the machine. We want to see a pattern. Do you understand that? You wake up in the morning, you want to trade. You wake up in the morning and you're hungry, so you want to find some food. Okay, you'll find something on the shelf. You're like, lima beans for breakfast, but better than hungry, right? So, anyways, you'll want to find a trend. You'll want to find a reason to trade, and the message is the opposite. It's telling you that you will find something, but that's the problem. So be very careful. So whatever you're trading today might be a one-off. So if you're trading gold, it's just gold. If you see an opportunity on a yen pair, it's just a yen pair, but there's no trend. So you're only seeing short term. And that's when you very often get into cross pairs like the Euro CAD and the Euro Aussie and that kind of stuff, Euro Kiwi. And that has been it's been that way for a while. So we can take a look at some of these. Let's maybe pick on a new one. Okay. Okay. Let me zoom in so you can see it better. Okay. We were trending bearishly, then it made a higher high, then it made a higher low. So therefore it's thinking higher high in the future. You see that? Now, I just randomly grabbed this. You might like pound better. You might like, something better. You might like dollar. You might do Aussie dollar down or something. So I just picked one randomly, in particular, a cross pair. Seasonally on this pair, it usually falls this month and then kind of picks up. So what are we, 1/3 of the way into the month? It's a little early to be catching a bid on this, but it is what it is. We know looking, let's say if we were looking 90 days out in the future, 90 days, not 90 minutes, 90 days. Well, we would assume over the period of the next 90 days, this will go up. So now that's the challenge. Okay, great. So in a window of 90 days, we would look for this to turn bullish. Now, looking at the COT data, it favors euro. Retail sentiment favors the euro. Why? Why? Because they're heavily, heavily, heavily short. Okay. Currently, the Euro Aussie gets a reading of +1 in retail sentiment. Remember, if the retail crowd is very long, we look to short and vice versa. So they're heavily short, so we want to buy it. We want to trade against dumb money. I hate the word. I have a lot more respect for retail traders. But nonetheless, that's the old saying, trade against the dumb money. The other way of looking at it is they're just very heavily short, and there's probably a turning point. If we hit their stops, stop, the market will pop, right? So you want to look for bottoms is a better way. You're not trading against them, you're looking for reversal patterns. And if you hit their stops, remember the stops are close. Okay. Again, like when I talk to my hedge fund friends that do Forex, their stops are hundreds of pips away. I was just 2 days ago, I think, a buddy gives me a call, and it's late. I already have a glass of wine in one hand and Cheetos in the other. I'm sitting down to watch a World War II documentary. Like, oh, I'm waning, baby. And then all of a sudden, calls me. I'm like, oh, I got to take this call. Right? So 5 minutes later, I got my coffee going. We're talking about it, and he's like, well, I got my 4 trades for the month, and I really want to find something non-correlated so I could get that up to maybe 5 or 6 trades. But he's talking like done for the next 6 weeks, let's say. And he was hoping to find 2 more trades. Now, I'm not recommending that for us, being much more retail, but it's nice to see the thought process here of the time that these trades, that he thinks in let's say 4 to maximum 8 week increments. And very often retail is thinking like, what's going to happen in the next 20 minutes? So we got it somewhere. I think there's a happy medium, right? And so in this strategy of longer term, you could say, well, if the market's been down for quite some time, and QuantBox is showing you January was a bloodbath, and February has been down, then at some point in this next 90-day window, it probably will be no longer down. So you would look to be a longer term trader somewhere in this window. You're saying, okay, I'm buying a bottom, I'm buying a floor, and I'm going to stay in it for that next period. And much of the profit will be these guys going from bearish to bullish because, they're shorter term traders. That's how I look at it. Retail is really just shorter term traders, and institutional is longer, right? And so institution wants to buy at the bottom and sell at the top. Retail is just chasing their tail. But what'll happen is down, they all get stopped out, and then they turn around like, I guess it's up now, and then up. Okay. So that's how you kind of want to put that information in there. So we can go to our chart and say, well, has it fallen enough? Is there rational support for the end of the downtrend? Would there be some up in this? And then you start doing your investigative research on your charts. Okay. Oh, yeah. Yesterday on the breach, I got out of my short. What else? Oh, yeah, because traders trade always. I shorted this. Probably not a good trade, but I couldn't help doing it. Because at Forex.today, we actually talked about that, what if scenario that is a top. And then I drew the arrow and everything. And I'm like, I got to be a cheeky monkey. I got to try. So anyways, don't look at that. All right. Euro Aussie. Yeah, let's go and take a look. Euro Aussie daily. And so what we're trying to say is in that down period that we were observing, and remember, QuantBox had a big gray line, which means that January period was down. Do you have a narrative that says now that it's been down, up, down, up, down, up is the new law of the land? Well, let's see. That's January 1st. Okay. Yeah. Here's the end of January. So by what? By the middle of January, we're up here. Or sorry, February. And then by the end of February, we're here. And then by March, we're up there. Maybe, right? So see what I'm doing here is I'm using the data in QuantBox to create a narrative. I'm not just like, QuantBox told me to buy this. No, 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 no. I'm trying to think ahead. I'm trying to plan things rationally. So I have to have real data, and the real data leads me to some clear path. And then I start to create a narrative of, should I be bullish on Euro Aussie? If so, now I go to my charts and say, well, how do I put together the technical analysis? And then I can drill down even further and say, well, okay, so you could use now Fibonacci to say this is a 618, so that's going to predict a 1382. Actually, 1382 is probably more like here. Okay, so you're like, okay, that could be interesting. So then you adjust your tools, you go in and let's update this. Okay. And here's the recent down. So that could have been a dip. I have to change my tools. In this case, in that narrative, we are bulls because we can see in the next 90 days, there's a normality. It would be normal for this to be more up than down. So you have it all set that way. And all of a sudden you get this, the charts become more and more clear. This is an old trade. We can get rid of that. Okay. So now we have sort of a clarity now based on our narrative. Okay. So we had an up, then we had a roll reversal. Okay. Then we're trying to climb here. We're climbing the moving averages, which now on the daily is technically bullish. You see that? 21 is above the 55. Technically, this is bullish. And we had the dip here, and the dip worked perfectly. And the target based on that is here, which is basically that Fibonacci 6181382 move. And that would be a plan from there. Can we get this higher? Okay. So this is right a monthly pivot. Okay. And then if that happened, I don't know what next month's pivots will be yet. This is just an estimate based on what it's done, but it hasn't done anything yet. So I would probably look at it like this. And then March March would probably be something like this. Now, why can I plan out March? Because QuantBox has shown me March typically is up. So January, okay. Are these weeklies? I guess these are weeklies, right? Sorry about that. These are weeklies, but still, okay, up this week, down next week for the dip. Okay, same thing, same. And that this could continue for a while because we can see out into the normal price time continuum, 30, 60, 90 days. So we could day trade this, we can swing trade this, but you could also position trade this. Institutions want to be in it longer, and retail is going to get knocked out. And that's where usually the pop comes from. Okay. Yeah. And just so you know, these dots below us, they're suggesting, so I'm talking about these dots down here, they're suggesting if you're an institutional trader and you're in this for a bit, okay, it's assuming if you bought here, okay, or if you bought here, every day it tells you where to put your stop loss. So that's where institutional stops are right now. Okay. So not quite at break even on this one. And if you got in somewhere around here, And the best way to do it, of course, is this, this, and that. So, you know, if I was Johnny on the spot on this one, I would say the most likely place you're long is here. And so your stop is now at break even. And every day it'll move it up based on volatility. And the way that this chart is set up is that's what it looks like we're going to do by the end of the week. Now, remember, we don't know what it's going to do, but that's the technical and the fundamental combined. Remember, QuantBox has a positive score, so it's thinking up. And how does it get the score? It looks at 9 different things and looks at what usually happens. Cool. So this is a tough one because we know there's no underlying interest trend in the moment. So if we're going to do anything, we're going to lean on the past. Doesn't predict the future, but it presents like a foundational base to why you're buying or selling something. And when you lack the trend, you want to be on a cross pair. If we have a trend, you probably want to be on a dollar pair. Okay, so that's how we got here. We looked at the data. We matched a narrative with market conditions. That's something I didn't highlight, but we didn't do dollar pairs because we lack a dollar trend. So then we got to here, and then we looked at it, and we saw economic data and seasonal data and price data and market positioning data, and we combined them all into buckets of is this good, is this bad, and put them all together, and it's much gooder, meaning up, because it doesn't actually think good or bad. It just says more likely to favor euro. So you put all that together, and now we do have a logic for doing this. So even if we're wrong and we place a trade and lose money, we're not being random. In particular, when the market is more random than usual, then we have to be more solid, more logical than normal. And so just getting to this pair is a big deal. And now we do our technicals, and now you got your daily swing. Now maybe we buy dips. Now, you know, this kind of stuff. And now we do our price action technical analysis and pivot points from there. But it's just think of all the other stuff we're not looking at. The stuff we're not doing, the fact we're not doing that stuff is a really good thing. We're not looking at the wrong place. If this doesn't move and something else does, don't look at it like we're on the wrong thing. No, this is the right thing. And there are a few other things like it. But what I'm suggesting is that the data says the other thing, if it pops today and moves and you didn't trade it, it's because it was unpredictable. And you shouldn't be trying to build a career on getting unpredictable trades. Cool. So sound foundational base of logic. And if it works because it was predictable. But if you can't predict it, you shouldn't be trading it. If you didn't have it planned out, you shouldn't be doing it. So very cool. All right, well, I'll leave you to it. It's going to be an interesting day. S&P 5,000, man. S&P 5,000. It's going to be the story of the day, the week, the month. We'll see what happens. I'm no longer hedged. I had to pull the hedge. So I'm like, I don't know. Are we going to breach 5,000? Well, it's weird to think that I saw it breach Dow 1,000. Or I mean, S&P 1,000. I remember the Dow dropping below 10,000 and then coming above 10,000. And then like a couple of years later, back below 10,000. And then Dow back up about 10,000. Where are we now? 40,000, Dow 36,000 or whatever it is. It's like, you're like, wow, things things have gone up, huh? I mean, imagine I held Apple from $6 a share. I held it for almost 30 years. You're like, amazing, these things. So to then look at these stock markets and they've tripled and quadrupled. Wowzer. Yeah. So, yeah, peace on earth. May the pips be with you. May your profits be above average. I'll see you over at Forex today, I'm sure. And then over at Investor Bootcamp at 4, we have the swing trading group. So day traders and swing traders, I'll see you over there. Busy day. And I have meetings with the development team, not just for QuantBox, but also for traders.co. So that is happening. Nice. Cheers.